Hello, welcome to my channel today. This is the King's Tutor. Okay, it's the first time of joining us. Thank you for clicking to this. Ensure you like, comment, subscribe, share this video. Okay, now I want to continue our series on partnership. Although we've seen the introduction video of partnership and we'll have solved questions relating to that. Now I want to see another aspect, which is what the goodwill. Okay, what is the goodwill? Now, the aspect of goodwill we want to see is the involvement of goodwill in partnership. Okay, not goodwill as it were. Okay, but what is goodwill? Now, according to Elton Mayo in 1890, it says goodwill is a probability that customers will continue to patronize old business even when there is change in management. Now, what does this mean? It means that the business has grown to the extent that even when there was change in management, the customers, the outside world would not be aware because of the name and the reputation that business has gotten. Okay, so that is goodwill. So Eltimeyer was trying to say that even when there is change in what the management, even when it will not be announced, the business will still thrive because of its name, reputation, quality of goods it has what attained over the years. Okay, so goodwill can also be seen as the advantage a firm has over its competitors as a result of its name, like we said before, the location of the business, and also its quality of goods. Okay, so goodwill as it were are inherent in businesses. For instance, like MTN as it were has goodwill in the sense that whoever has a smartphone, one of the network that comes to mind whenever you have a smartphone is MTN. It is not because there are no other networks that are good. It's because over the years this network has proven to be what? To be good. Okay, this network has proven to what? To have qualities over the years. So even when there is change in the management of MTN, most persons will still patronize MTN, even when the owners will tend to sell that company. Why? Because of goodwill. Because that name alone has gained maximum acceptance. That is what we term as what? Goodwill. Okay, and also in financial term, goodwill can also be seen as the excess of purchase consideration over the value of its net asset less liability. Now, what do we mean by that? For instance, if there is a purchase of a company, if a company wants to sell its good, one of the things that stand as the price tag for that company is the summation of its assets, what they have in the business, less their liability. Okay, so we are saying the goodwill is the excess of purchase consideration over the value of the net asset. Like, for instance, what a buyer is willing to pay will exceed the asset in that business. That excess they are paying for is what we call goodwill. For instance, if the net asset in a business less liability is worth 50 million, okay, and a buyer that wants to buy that business is having a purchase consideration. What is I'm considering to buy that business, but having a consideration of, let's say, 100 million. But what the net asset, what that asset in that business is worth is 50 million, and he's intending to buy it 100 million. The excess of this thing, which is 50 million, is the goodwill. Why? Because only that name of that business can generate more than this money over time. So people tend to pay for that name, that goodwill they've gotten. Okay, like the example we use, MTN. If anyone stands up today, or the owners of MTN stand up to sell MTN, they will not sell MTN in equilibrium of the asset of that. As a matter of fact, goodwill is an asset, but an intangible asset. Intangible in the sense that it cannot be seen, touched, or felt, but it exists. Okay, and the aspect of asset it is that you can't sell it apart from other asset of the business. It can't be sold like that, outrightly like that. No, it is sold in what collaboration with what other assets of the what the business. Okay, so that is what we term as what as goodwill. Okay, so we have types of goodwill. We have what we call the purchased goodwill, and the inherent goodwill. Now, the purchased goodwill is the goodwill that is generated when you purchase a company. Whenever a company is being purchased, that company, there's a goodwill that is inherent in it. So when you purchase that company, the goodwill that is there in that company becomes what a purchased goodwill. Okay, it arises from the purchase of what the net assets of other company. So when it is being purchased, that goodwill attached to it becomes the one the purchased goodwill. While another one is the inherent goodwill. The inherent goodwill is the goodwill that is residing on a particular business or a company as a result of the quality of services they've been offering over the years, as a result of their value. Okay, it is inherent inside that particular company. So those are the two aspects of goodwill. Now, there are different ways a company can evaluate or tend to value their goodwill. Though this video is not for that, we have the capitalization method, we have the number of years method, and other method in which they tend to apply to generate the amount what that business is worth in terms of its goodwill. Okay, but we're going to see a separate video on that, not on this. So we want to see the relationship of this goodwill in terms of partnership. Our aim is in terms of partnership. Now, there are different reasons or different ways when a partner, let's say two partners, comes together to start up a business. Now, over the years, there might be changes in the partnership. Now, some of the reasons that might cause changes in this partnership is one when there's admission of a new partner. Two, changes in the profit ratio. And three, when a partner dies. Okay, so what we are saying in essence is over the years, 2 or 3 persons might be running a partnership business. But if they run that business for 2-3 years and it is constant, there are rules and regulations. But over time, there might be changes that might occur in that partnership. And among other reasons that might cause the changes, these 3 is very unique that might cause changes in the partnership with agreement, what they've agreed previously. The first one is admission of a new partner. The second one is changes in the profit ratio. And the third one is when a partner dies or retire. Now, the first one, admission of a new partner. Now, most time, a partnership business might tend to bring in more persons into that business. Okay, if when they started there are just 2 or 3, they might decide to bring other persons. So when they bring other people into the business, it means they're admitting. So that person coming in will have to bring in capital. And in essence of apart from bringing in capital, that person will have to pay for goodwill. Now remember, that business was previously owned by either 2 or 3 persons that started it. So they've run the company over time. Remember what we talk about goodwill, okay? That even when there's change in partner management, now they've run the business over time. They've had a good name, they've had good reputation, they've offered good quality of goods and service. So when that individual is coming in, now I'm talking about admission of a new partner, when that individual is coming in, that individual is coming to enjoy most of this benefit that he has not labored for. It was previously labored by those previous old partners. Okay, so that will make, for instance, will make them to have high sales. So this individual that is coming now is coming to enjoy that goodwill that have been inherent in that business. So in order to compensate the old partners for their job well done, because they will now have a new profit ratio. If there's admission of new partner, they will have what? A new profit ratio that will include both the new partner. So the new partner will start enjoying from the profit. But before now, these previous people might have suffered loss over the years trying to build that business. So in order to compensate them when they admit new partner, it is to recognize goodwill in that business. It is what? To recognize goodwill in that business. So that recognition of goodwill in that business will be paid to the old partners in their profit or loss sharing ratio. In their old profit or loss sharing ratio. Let me repeat. It will be paid to the what? To the old partners. When a new member is coming in, they are going to recognize goodwill. A goodwill account is supposed to be open, and it will be paid to the old what? Partners as a compensation for them as regards the what? Goodwill in that business. Okay, so when this happens, when we tend to open a goodwill account, when goodwill account is open under admission of a new partner, we said we have two situations when goodwill is open and when goodwill is written off or closed. Okay, so like I said before I got here, when there is changes. So when goodwill is open, when there's admission of a new partner, now what do you do, or what do you tend to do? You have to debit the goodwill account and you credit the partner's capital account in their old profit ratio. Their old profit or loss ratio. That is when goodwill has been recognized, have been valued. You've known the worth of goodwill in that business. So when it is open now, you debit the goodwill account and you credit the capital account in the old profit ratio. That is the profit ratio the previous partners have before the admission of the new one. So it will be credited to them so that they can enjoy that. Okay, so that is when a goodwill is what? Open. Okay, now the second situation, when goodwill is written off. Now if probably after they've opened it, you want to write it off, okay, the account. Now once they want to write it off, it is the corresponding entry of this. So it will not be debit the capital account in their new profit ratio. Now the new profit ratio now will be the ratio that involves both the new what? Partner. Okay, and credits the goodwill account and credits the what? The goodwill account. That is when there is goodwill. When goodwill is open, you do this. You debit goodwill account and you credit capital account in the old profit ratio. And when goodwill is written off, you debit the capital account in the new profit with the new profit ratio and you credit the what? The goodwill account. Now all this relates to when there is admission of a new partner. Like I said, when a new partner is coming in. Okay, and the next one also, what causes change? Remember, I was talking about what causes change in the partnership activity. The second one is when there is changes in the profit ratio. Now, most time, even if there is no admission of a new partner, probably it is three persons that have been doing business over the years and they've had a constant profit or loss sharing ratio, either 2:2:1 or 3:2:2. Okay, depending. So over the years, they might decide that no, things are getting high, let's change our profit sharing ratio. So when they decide to change their profit sharing ratio, definitely they have to recognize goodwill. They have to what? Recognize the goodwill, because they tend to know that either their profits have what? Have increased over time because of the goodwill and the good name and the quality of services they've been offering or rendering. Okay, so definitely they have to recognize goodwill. So that will amount that they also open a goodwill, and also when goodwill is written off, we are going to see that. And also when a partner dies or retire, when a partner dies or when a particular partner retire, it also causes a change in a partnership. It also causes a change in the partnership agreement. They also have to revisit what they've written down. Okay, so these are situations that causes change in a partnership agreement, that causes change in the partnership, the admission of a new partner, the change in the profit ratio, and when a partner dies or retire. Now we are going to see an example that involves admission of a new partner that corresponds to when goodwill account is open and when goodwill is written off, so that we can see how to solve it. Okay, don't go anywhere. Please ensure you like this video now, comment there, subscribe. Okay, thank you very much. Now let's see that's an example on how we can solve this. Okay, now let's see the question. Now the question says Olu and Ariyo are in partnership. They shared profit equally. Now look at the previous ratio, Olu and Ariyo equally. So that's 1/2. It was decided to admit Aluko, and he brought in cash 7,000 as capital. It was agreed that the goodwill was worth 15,000. That is the goodwill of that business was worth 15,000. It said the new profit sharing ratio is to be Olu 3, Ariyo 2, Aluko 2. The balance sheet before Aluko was introduced was as follows: capital Olu 20,000, Ariyo 20,000, 40,000, net assets 40,000. Okay. Now they said show the balance sheet on 1st January 2008. This is what we are about to do after goodwill has been taken into account. If the goodwill account was opened and also the goodwill account was not opened. Okay, so we have our solution. Now remember, the first one we are going to do is if goodwill account was opened. Okay, if goodwill account was opened. Now, from this now, remember we said if goodwill account will be opened, you debit the goodwill account and you credit the capital account in their old profit or loss sharing ratio in recognition of the goodwill in the business as a compensation to the old partners and in their old profit or loss sharing ratio. So we are going to get the old ratio and know the old the goodwill. Now from here they said the goodwill is worth 15,000. Now said goodwill is 15,000. In their old profit or loss sharing ratio, they say they share profit equally. So Olu and Ariyo, it will be 1/2 times 15,000. Let's know the value first. This is 7.5, and Ariyo is 1/2 times 15,000. This is what? 7.5. So what do we do? So what do we do from here? Now we now have to debit the goodwill account. So we have a goodwill account. We have to debit it with the amount. So it becomes Olu 7.5 and Ariyo 7.5, and that's 15,000. 15,000. Okay, so bring it down here as well as brought down 15,000. So that's the goodwill account. We have debited it. Now also the credit entry goes to the capital account. So that's what we'll do here. So we now have the capital account. The capital account. Now in this situation now, the capital account will involve Okay, so now we'll have here that is particulars. We have Olu, we have Ario, and we have the new one, Aloko. Olu, Ario, and Aloko. Okay, so from this now, let's represent what we have here in the balance sheet. Their capital, balance brought forward. Remember, this is a capital account. So balance brought forward from the capital. This is 20,000. For Rio is 20,000. I look at the new partner, nothing yet. And also, they said he brought in cash, 7,000. I look at brought in cash, that's a new partner. So we now have here cash. This they did not bring 7,000. So the goodwill now, remember I said the goodwill in the old profit ratio will debit the goodwill account and you credit this. So this becomes 7575 and dash. So we now have to close this account. So this is 7,000 and this is 27,500 and this is 27,500. So we have a balance carried down here, 27,500, 27,500 and 7,000. So this is 27,500, 27,500 and 7,000. So with that, we have completed the entry. We said when our goodwill is open, debit their goodwill account. We have debited the goodwill account in their old. Look at their old profit ratio is what? Half, 1/2. So 1/2 gives us this. We debited this. Okay, we debited this, and the capital will credit the what? The capital. Okay, so and now the question they ask us, they say show the balance sheet on 1st January after the goodwill has been taken into account. So after this goodwill now, this balance sheet will change. That's what we want to show. Now let's show the balance sheet. So the balance sheet will now look like this. The balance sheet now will now look like this. Now capital will now have a new capital. Capital for Olu is 27.5. For Ario is 27.5. For Aloko is 7,000. So if you add this up, this will give us 000 is 22,000. 62,000. Okay, so the credit side now would now be the net assets. The net assets is 40,000. 40,000. Now cash, there is cash there that was brought by the new partner, 7,000, and the goodwill that was recognized is 15,000. So if you add this now, it will still give you the same thing as 22,000. Okay, it will give you the same thing as 22,000. So that is that. So that is the first one when goodwill account was opened. Okay, so this is what you do using the old ratio. The old ratio is half. We got that and we debited the goodwill account and credited the goodwill account and the capital account in their old profit or loss sharing ratio. And we recognize the balance sheet, the amount here. This is our previous capital, cash that was brought by the new partner. Okay, this is it. And this is the way the new balance sheet will appear, recognizing this. Now let's now do when goodwill account was not open, when they write it off. Let's do that now. When the goodwill is written off, now we said when it is written off, you are going to what? You are going to prepare that using the new profits ratio. In the new profit ratio now, you have to credit the goodwill account. Okay, you have to credit the goodwill account, and you have to debit the what? The capital account in their new ratio. In their new ratio. Now, for this now, let's get the next one. It says goodwill account was not opened. Now, the first thing we have to do, let's get in the new profit or loss sharing ratio. They gave us, they said the new profit ratio is now what? Remember, the goodwill is still 15,000 in the business. So the new ratio now will now be Olu 3 over 3 plus 2, 5 plus 2, 7. That is 3 over 7 times 15,000. Then Ario is 3 over 2 over 7 times 15,000. And Aluko is 2 over 7 times 15,000. Okay, so now 3 divided by 7 times 15,000, we have 6,429. Okay, the next one, 2 divided by 7 times 15,000, we have 4,286. So also have 4,286. So we now have, let's leave this as 6,428. So when we add up, it gives us 15,000. Now in this, this is the new account. So Goodwill account was not open. This is the new profit, using the new profit ratio. Okay, so remember, we are going to credit the Goodwill account and debit the what? The capital account. We are debiting the what? The capital account. So let me clean this part. So if we have here our goodwill, remember I said we will credit it. Now we are crediting it, including this now. Look at the old one, we'll write it here. Olu 75, Ario 75. Now the new one now will now be credited. Olu 6428, Ario 4286, and Aluko 4286. So if you add this up now, it will give you 15,000. If you add here 15,000, so there's no balance carried down. So it has automatically balanced itself. That is, it was not open. We are writing it off. So it has automatically balanced itself. Okay. So the corresponding entry now will come here. That's crediting the capital account. So the capital account now will look towards. Capital accounts will look towards. So if we have Olu, Ario, and Aluko, Olu, Ario, and Aluko. Now, if we represent that back as balance brought for 20,000 dash, this is the cash that was brought, and this is 7,000, and goodwill that was previously there, 7,575. Now, remember we credited this, we said credit in the new profit ratio. Now we're going to debit it now. So it will now be goodwill, will be here, goodwill written off. Goodwill written off. So it is 6,428, 4,286, and 4,286. So that's all. So we're going to get the balance now. So balance carried down. So to get the balance now, so this is 27,500, 27,500, and this is 7,000. So 27,500 minus 6,428 is 21,072. 27,500 minus 4,286 is 23,214, and 7,000 minus 4,286 is 2,714. So when you add everything here, it will give us 27,500, 27,500, and this is 7,000. Okay, now this is the capital account. We have effected it in the new profit ratio now. Now let's see the balance sheet the same way we did it, where it has appeared like this now. Okay, let's see the balance sheet. So if we have balance sheet, so our capital now, the capital has changed. It is no longer this as per when it was open. When it is closed, now look at the new capital. Olu 21,072, Ario 23,214, and Aluko 2,714. So we have net assets. Remember, our net asset is still 40,000. We have cash that was brought 7,000. So that is all. Let's add it up to see. We have 21,072 plus 23,214 plus 2,714. That is 47,000. And 40 plus this, that is 47,000. There is no goodwill because we have written it off. Okay, so that is how to show when goodwill account is open and when it is not open. Please, any question you have, as per you don't understand, watch the video again. If you don't, please ask the question in the comment section. Thank you very much. Ensure you subscribe, like, comment, and share. Thank you.